Well, hey there, everyone. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. It's Friday, March 20th, and welcome to our Friday mailbag episode. A lot of deterioration, I would say, market-wise this week, but today, Friday, was sort of the big exclamation point to a risk-off vibe. The S&P down about 100 points, continuing the push below our line in the sand of 65.50. Today represents that first close below that ultimate line in the sand that we've been talking about for quite some time. We've already broken the 50-day moving average. We've already broken 6,800, which was a tactical support level. We then broke the 200-day for the first time since May of 2025. And then today we close below 65.50 with authority. I would argue the market very much in a risk-off position. We're going to talk briefly today about some quick check-ins on the market. I do a weekly market recap for my Market Misbehavior Premium members called our Weekly Flight Plan, where we talk about what happened in the week that just occurred and look forward at the week to come to identify some key levels and patterns. So if you're looking for that sort of sense of stability or insight to navigate these choppy market conditions, check out our premium memberships at marketmisbehavior.com/premium. We'd love to have you as a premium member, and you can enjoy that weekly flight plan along with our monthly review, our member community, virtual courses, all sorts of cool stuff. Find more info at marketmisbehavior.com/premium. Make sure you use the code YouTube, by the way, when you check out for a good deal on your new account. Let's talk about market conditions here on Friday, March 20th, just as a quick update. So here the S&P closed down 1.5% to 65.06. The NASDAQ composite down 2%. Mid caps, small caps, all down 2+%. Best performer here is the Dow, which is still down about 1%. So this was a pretty ugly day all around. It was an options expiration day, and volatility pretty severe. The VIX, by the way, continued to push higher. Got as high as 29 today. Settled back down, but still up almost 3 VIX points. Finished the week just below 27. Rates continue to go higher. The dollar continuing to go higher as investors are selling bonds, as investors are concerned about inflationary pressures. One of the most obvious signs of inflation, crude oil prices going higher, which just implies that's going to affect all sorts of other goods and services, which is why other names are struggling. Gold and silver continuing their risk-off trajectory, having a pretty rough Friday. Gold down 3%, silver down even more. Cryptocurrency is kind of the only area of kind of traditional risk assets not showing a ton of pain. I mean, Bitcoin's still holding 70K. That's not great, but it's not horrible, right? With the S&P and the NASDAQ breaking down. Now, Bitcoin and Ethereum had already been going down for quite some time. On the sector side, energy not doing particularly well, kind of flat for the day, even though crude oil prices were surging higher. Financials were the best sector, up about 0.2%. But the real pain is in the bottom here with utilities and real estate, both down 3 to 4%. Technology down 2.3%. Consumer discretionary down almost 2% as well. The breadth was ugly here on Friday with 84% of the New York Composite Index closing lower. We're going to have a lot more to talk about with our premium members in terms of digging into some of those, some of the nuances of what I just shared with you, particularly the continued weakness in the Magnificent Seven. Stocks like Tesla breaking down in a pretty significant way here. Again, and the bullish markets go up, right? And bearish markets don't, is the way I would generally describe it. So I was asked on Thursday if this is a capitulation day, and my answer was, doesn't look like a capitulation day to me. And we're continuing to go lower. So we're seeing lower lows and lower highs. We're seeing weaker momentum. We're seeing weaker breadth. We're seeing weaker sentiment. Most things kind of struggling here. So with that as a kind of rough backdrop to our all mailbag episode, hey, I know you guys are still trying to navigate these markets, and I'm here to help you along the way. We'll be, and actually, as a quick reminder, we're off next week because of our family vacation, going to Disney World, taking the family down there. We're meeting the Kellers from Ohio and New York, and we're all going to hang out in Disney for the week. So I'll be back, traveling back up here to Seattle on Friday of next week. So no live market recap, unfortunately. I will be continuing to monitor the markets and sharing some updates with our premium members as needed. We do have some content slated to go out, including the latest episodes of our Market Misbehavior podcast, which we're just spreading out here over the next week, and also some other videos on our YouTube channel. So keep your eyes peeled on our YouTube channel. We'll have some good things to get you thinking and continue the juices flowing. And then we'll be back the week after next to share some great market updates. That'll be the last week in March there. All right, question number 1. Dave, could you share your analysis of the S&P 500 monthly chart? The PPO indicator appears to be showing a crossover, and it does not look particularly bullish. I'm happy to share the monthly chart of the S&P. All right, let's bring it up. I have a monthly template I usually use. That's this one right here. So, it's so funny. I gave a presentation to the students at the University of Richmond this week. To shout out to any of those guys, any of the spiders, if you're watching the show today. But one of the charts I shared with them was not this one, but I'll show you which one it was. It was a similar chart that I love to share with students just to show kind of the long-term trend in the markets here and what it means. We were looking at this chart, historical charts. Here, this one. This is the NASDAQ composite going back to 2009. And this is a monthly chart. We're using a log scale or semi-log scale, which we will also use on the S&P chart. And I would first things first, on a long-term chart, like a weekly or especially a monthly chart, you have to use a log scale. There is no legitimate, intelligent, intellectual argument, in my opinion, that can justify using an arithmetic scale when you're looking at this period of time. Log scaling was meant for this type of trajectory, this type of long-term consideration where you're thinking about percentage moves and long-term gains or losses. You are doing yourself a disservice if you look at arithmetic charts. So if you're doing it right, the scale on the chart should look like this, where the higher you go, the more that the prices are compressed, because now we're looking at a consistent percentage gain. Now, why that's important is when we're looking at a monthly chart of the S&P or the NASDAQ, a trend line with a consistent slope, as we see here, represents a consistent percentage gain over time. And if the market is getting further away from that uptrend line, that means the rate of advance, the rate of change on a percentage basis is increasing. If it's going lower, that means the rate of change is decreasing. And I think that's arguably the most important consideration when you're looking at long-term returns, is thinking about the percentage gains and the changes in that price momentum. So please use a log scale chart on whatever chart platform you're using. Super important. Here, using that trend line, you can see that the 2009 low, that's the great financial crisis low, connect that with the COVID low in 2020. Look at how that lines up almost perfectly with the lows in the fourth quarter of 2022. Look how it lines up almost perfectly, but not quite. The market did not quite get down there at the April 2025 taper tantrum or tariff tantrum low, but it got pretty close. That represents how much room we have to have a cyclical downdraft, to have a painful pullback period like we saw in 2022 or in 2020 or in 2018 or in 2015 or any of those other pullbacks, and still be well within the boundaries of a long-term uptrend, right? The NASDAQ composite can come all the way down from 21,000 and change to like 17,000 over the next, 3 to 6 months, and still arguably be in an obvious still secular bull market phase. That's how much room the market has. So when we're seeing market deterioration like we're observing this week, I think it's important to remember that still all of that pain we've experienced this week is just this little blip within a long-term uptrend phase. There's a lot worse the market would have to do before it looks like anything other than a secular bull market. So that's my starting point to a discussion to the S&P 500, right? We could see a similar pattern, obviously, to the NASDAQ of these, cyclical pullbacks within the secular uptrend. Your question was on this, right? What's your analysis of the monthly chart? So I would say, number one, the monthly chart is a fantastic reminder that we are still in the midst of a long-term uptrend. I think we'd have to have a lot more deterioration before I think you could label the secular market, secular trend as anything but bullish. The monthly PPO is what I'm showing here, and you actually mentioned that. Just showing a crossover here. Now you have to remember this is the current month up here. This is the month of March. It's not quite done yet. So on a monthly chart, we have to be careful to draw any conclusions on the current data until the end of the month. So we've still got another week and a half of trading in March. Once that March monthly close is locked in, then we can consider this new candle as part of our analysis. Until then, we can't. So the monthly PPO is currently showing a potential sell signal, but this is still an active, excuse me, this is still an active month. So we can't draw too many conclusions on that data point because this is the month when it's potentially breaking. So we have to wait for the monthly close to be locked in for this sell signal to be, or this bearish signal to be confirmed. Does that make sense? So, right, and it's kind of like a daily chart and you see the candle does something. You can't assume too much about that because the candle could change dramatically between whenever you're looking at it and the daily close. And we're kind of having that on a larger time scale here with the monthly close. So first off, it's a potential PPO sell signal, but we have to wait for that to be confirmed at the end of the month. So we got another week and a half to validate that. If it is a confirmed sell signal, that means it's in line with a lot of previous corrective periods, right? And we look when the monthly PPO has given a sell signal, it's been the major cyclical downtrends that we've observed going back to the great financial crisis and even well before that. So that's why on the monthly charts, I have the monthly PPO, because monthly PPO sell signals are usually pretty bearish. Sometimes it's a couple months long, sometimes it's many months long, but it's usually something. So that's my analysis of the monthly chart. Long-term trend is still great. Monthly PPO signal, we have to wait for the end of March to confirm that monthly close. Then I would definitely set a reminder to go back to that chart. I'm actually going to set a reminder to add that on the show for the last trading day in March. Great question, by the way. Thanks for that. And hey, I always tell people, when in doubt, zoom out. So the fact that you're asking about the monthly chart, I love that. That means you're doing that. It means you're listening and you're thinking about longer term implications of short-term moves. Kudos to you for asking the question. Next question, simple and straightforward. Do gold miners lead gold? The question is straightforward. I don't know if the answer is straightforward, but let's take a shot at this. So how could we assess that from a technical perspective? There's probably a really cool, like, statistical way we could do that, like in Excel, and actually quantify the relationship. But here's what I'm going to do. I'm going to bring up the GDX. That's the VanEck Gold Miners ETFs. I'm looking at gold stocks there. I have a chart where I can compare two different things. So we've got gold stocks on the top, and in the bottom, we're going to do the GLD, which is like spot gold. And I'm going to change this here. All right. So in the top, we have the gold miners, the gold stocks. In the bottom, we have the gold shares. That's the, basically physical gold. These are both ETFs that track gold stocks and then physical gold. Gold stocks in the top panel, physical gold in the bottom. So, I mean, right now, obviously they're pretty similar, right? And we can calculate that pretty easily because there's an indicator on stock charts called, what is it called? Correlation. Hold on, why didn't it? Oh, that's not the ticker. So now I'm saying, show me the correlation between gold stocks and physical gold. We can see that most of the time it's very, very close to +1, right? I mean, right now it's 0.92, which is a strong positive correlation. There have been times when they become a bit disconnected, like we see, here in May of 2024, when the correlation went almost to 0. So, but on average, pretty strong positive correlation between the two, right? That makes sense. So we got that, right? So your sense that gold and gold stocks are generally related, that makes sense, right? Because they're looking at the same thing. Now, does one lead the other? So for this, I usually look at a little more data. So I'm going to look at like the last 5 years. And I mean, just eyeballing it, I would say it's probably the opposite. My hunch would be it's more common that gold would lead gold stocks. Let's see, right back in 2022, gold stocks made a new high, gold did not. They both started to break down right April, May of that year. But the gold not confirming the new highs was kind of an important lesson there. They're kind of moving very similar during this period. Look like here is probably a good example of where gold, physical gold, which is in the bottom panel, look how it's making a new 3-month high in March of 2024. Then it took about a couple months before gold stocks actually confirmed the new high. You can see that again here in early 2025. where physical gold made a new high in February of 2025, and gold stocks didn't make a new high until April of 2025, March of 2025. So, and then more recently, right, gold stocks made a new high. Physical gold did not confirm it. So my general sense is often gold will be leading, and then gold stocks will have kind of a catch up trade where they will start. It's almost like and that's when I usually think this is a good time to own gold stocks. So when gold's breaking out and gold stocks haven't yet, I'm usually thinking of gold stocks as a pretty good opportunity because of a potential catch up trade. Because gold is already working, that should mean gold stocks are doing well, and they're not doing well, which means people aren't, just recognizing that the strength in gold should probably be reflected in gold stocks. So I would probably flip that personally. I'd be curious if you guys see research or white papers or commentary that suggests the opposite. Oh, I'd love to take a look at it. Maybe I could interview them for the Market Misbehavior podcast and learn a little bit more about their methodology and what they're thinking, regardless of what's leading what. I mean, I think the problem for gold right now is that they're both breaking down, right? Both gold and gold stocks have made a new monthly low. And maybe this is why you're asking the question. Right now, this week, gold stocks actually broke down. And I'm thinking maybe this is why you're asking the question. Now I'm getting inside your head a bit, maybe. Because you see the GDX actually broke down while the GLD did not yet. And now they're both kind of making a new low to finish the week. So maybe this time it actually is gold stocks are leading. But the question is generally, I tend to follow gold more closely. And if gold is doing something and gold stocks aren't confirming it, I usually assume there's a catch-up trade happening there. Is there a difference between a hammer in a downward trending stocks versus an upward trend? Oh, I see what you're saying. Is there a difference between a hammer in a downward trending stock versus an upward trending stock? Yes. And I'm actually not going to use a chart. I'm going to use the proprietary Dave Keller using a notepad strategy. Hopefully this works okay as I hold my my notepad up to the monitor here. So when you are talking about a hammer, this is what you're talking about, right? Where the market's going down, you have this candle, and that's an upside reversal candle. That's called a hammer candle, right? Now you think of it as something hammering out a bottom. We're in a downtrend. You get this hammer that represents a short-term reversal because buyers are coming in and pushing the close up to the highs of the day, and then we're followed up with an uptrend. If that happens in an uptrend, it's actually not called a hammer candle. If you see this, which is the market goes up, we have this hammer looking candle, and then we go down. That's actually called a hanging man candle. It's not even called a hammer. So if the market's going down and we have that particular candle open and close near the highs, long lower shadow, that's called a hammer. Think of it as hammering out a bottom. If we have that in a top in a market going up, that's actually a reversal candle suggesting a downside reversal. And it's called a hanging man. Think of it like the head, and then the body is the stem sticking down there. If you flip those two over, by the way, if you're all jonesing for this is a horribly drawn hammer or a body here, but that if it's an uptrend and you have the open and close near the lows of the day and then the long upper shadow, that's called a shooting star. And then the final combination is this. Where you're going down, you have that candle, and then going up, that's called an inverted hammer. So anything at a bottom is either a hammer or an inverted hammer. If it's in an uptrend, it's either a hanging man or a shooting star candle. Now, again, I mean, what I would tell you is, regardless of what you want to call those, I always I like to tell people, like with candle patterns, don't get too nervous about mastering all the names, although it's helpful to give yourself credibility and give your a common language that you can use to discuss with people and make sense of things. And it's helpful that we use the right language to refer to patterns, I think, as much as possible. But in general, just keep in mind that if either of those candles pop up in an uptrend or a downtrend, it's a reversal pattern. That's what's most important to remember. If you see either of those pop up, whatever the trend was going into it, it's suggesting the trend is going to reverse over the next 1 to 3 bars, right? Regardless of what the label actually is. All right, before we continue, we've got a couple more questions to share with you here on a Friday afternoon in March. Before we do so, shout out to one of our new partners, EPS Momentum. I've had a blast experimenting with this platform. I'll be totally honest with you. I've been learning a lot about the platform, experimenting with it, trying out different scans, and impressed so far with the results. You can find a lot of information along with some fantastic tutorials to help you use the platform, because there's a learning curve, but I think it's worth getting through it if you want to find some good names demonstrating price and earnings momentum. Go to marketmisbehavior.com/EPS. If you use that, you'll get a special deal on your first payment, and also you can check out a free trial and experience the benefits of the platform. Great job combining price and earnings capabilities. Marketmisbehavior.com/EPS. Next question. When the VIX is persistently high, say around 25, is there a sector or sectors one should be looking at? Now, that's an interesting question. When the VIX is high, when volatility is high, is there a sector or sectors one should be looking at? So my cynical answer, or I guess sarcastic answer to your question, is you should always be looking at all 11 sectors, because it's important to have good market awareness. You don't want to, I always hesitate when people say, all right, when the VIX does this, what sectors should do well? And I appreciate your question. Your question is thoughtful in that you're thinking about what volatility might mean. But so I'll tell you some tendencies, but I will start with the overall comment that, listen, regardless of what you think should work, make sure you're focusing primarily on what actually is working. That's the point of our technically oriented process, is we're not thinking as much about what should be good or bad based on interest rates or inflation or the Fed or geopolitical events or volatility. It's focusing on what's working, right? It's focusing on what assets have the momentum. Where are funds flowing? Because that's what's going to cause prices to go up. Having said that, are there any tendencies? Yeah. So when the VIX is high, right? Think about what that means, right? When volatility is high, that usually means that investors are getting nervous. That's why it's often referred to as the fear gauge, right? And I like to think of it more as like an uncertainty gauge, right? When investors are nervous, when they're uncertain, that's when volatility increases. And we've for sure seen the VIX been trending higher so far in 2026, and it's continued going into this weekend with the VIX closing the week almost up to 27, just above 26 on Friday, March 20th. So volatility has been increasing. So what sectors tend to do well? So if you look at this, chart showing a higher VIX usually coincides with the S&P going down, particularly when the VIX is trending higher. That usually means stocks are trending lower. So it's going to be the types of sectors that do well in a market downturn, kind of the same list. So I would generally be thinking about the more defensive sectors, the four main defensive sectors, which would generally tend to do well: healthcare, consumer staples, utilities, and real estate. Now, again, those are generalities. Utilities have been doing some different stuff because they've been much more tied to growth stocks and the AI infrastructure play. Healthcare has kind of been doing its own thing and not trading in a similar fashion to the other defensive sectors necessarily. Consumer staples are getting hurt right now because of higher crude oil prices. So even though they're defensive plays, they also represent, they need consumers to go spend money, which seems to be less and less the case. But having said all of that, generally higher volatility, higher VIX means you want to bet on things that tend to have lower volatility or lower vol. And there's actually an ETF, and I should know it off the top of my head, and I don't. Yeah, SPLV is one of those. There was another one that's going to come to me well after this. But if you look at one of these like low volatility ETFs, those are ETFs that tend to overweight those more defensive sectors. Low volatility just means when the S&P is moving like 2%, it tends to move less than 2%. And that usually means if the market's going down a lot, this should go down less, right? Is the general way of thinking of being in a low volatility area of the market right about now. So that would be the answer. High volatility means defensive positioning, lower volatility, lower beta. Those tend to be defensive sectors like the ones we mentioned earlier. All right, last question, then we'll call it a weekend. Regarding the XLE, which we've certainly been covering because energy's been a strong performer going into March, but certainly through March as well. So regarding the XLE, what's the best practice to establish a new position or add to a current position when a stock or ETF is overbought and has such high momentum? That question could be the subject of like an entire hour-long webcast. So I love the question. So you're basically saying, right, with something like this, what's the best part, right? Something's just been trending higher for so long. So you're right. I mean, this is a high momentum area of the market. The energy sector was sideways in Q4 and just accelerated lights out positive once we flip the calendars to 2026. The relative strength has been quite strong. So at this point, strong price, strong relative, strong momentum, moving averages in the proper order, all kind of spread. I mean, it checks all the boxes of an uptrend, but you're probably nervous about chasing it because it's been up so much. And the XLE itself has gone from 45 to 60. That's a 50% gain just in the first 2.5 months of the year. So I get it. It's had a pretty good run. So I would say with this, using technical analysis, you have two kind of general, well accepted, well documented approaches. Number one, just add positions on the way up and use trailing stops to make sure you don't buy at the top, right? And if you do, you get out quickly. So a trailing stop would be something like the 21-day EMA, something like the chandelier exit system. It's designed to basically say, look, I'm taking a position, or I have a position. I just want you to let me know when there's at least enough short-term deterioration that we might be doing some sort of shift. And whether you automate that and say, look, if it hits the chandelier exit, just unwind my position, or whether you just set an alert and say, when any of these positions hit the chandelier exit or the 21-day EMA, I'm just going to revisit it and see if I'm still comfortable owning that position. That's the way to do it. And I would say, if that's your approach, remember that when you hit a stop, you shouldn't have to just think, all right, when I hit the stop, I'm stopped out. I owned 100% of it. Now I own 0% of it. I'm closing out the entire position. What I do a lot of times, think about the 21-day EMA or something like that as like an initial stop. All right, if we break the 21-day EMA, I'm going to take half off the table, just right out, no questions asked. Then with the other half of the position, I'm still going to have a 50% position. Then maybe I'm going to think about a secondary stop, maybe the 50-day moving average or something more, maybe we hit a key support level or something like that. And then you're sort of scaling out. And on the initial breakdown, you take some off, but if we immediately recover, at least you still have some of that bet on. You can add back to it if we continue to go higher. I would say in general, think of it as adding or subtracting to a position and not just all in, all out if you're using something like that. The other option is wait for a pullback. And the benefits of waiting for a pullback is you're guaranteed you're not buying at the high. You're not top ticking the chart. The bad news is you just may never get that opportunity. And that's the problem with like the XLE in January, February. Like we never even touched the 21-day EMA. So if you said, look, I'm going to buy the next time we hit the 21-day EMA, and then 2 months later, we've gone up 50% and you haven't touched it, that doesn't feel great either. So there's pluses and minuses to both of those approaches. I would just say, be thoughtful about which one of those kind of fits more into your line of thinking. With institutional money managers I used to work with, we would often look for pullbacks. We would think of it as like a buy on the pullback kind of chart, because you don't want to be trying to buy into severe strength. And with the size of the funds we were running, it just wasn't practical because it would be too difficult. So waiting for a pullback meant we had an opportunity to buy in on some short-term weakness. And that was a common technique. We would scan for stocks making strong long-term trends, but short-term pullbacks, so we could buy in on the dips. Neither one of those I don't think is necessarily the right answer. I think thinking about what makes more sense to you and how you're trying to trade and how you're trying to manage your portfolio could be the right answer for you. But those are the two general ways I would think of it. Number one, just buy no matter what, right? If the chart's good, add to the position, and then use pullbacks and use a break of a key support level as a stop, as a signal to maybe unwind that position. And so you're buying in immediately, but then you're just using trend following techniques to make sure the trend's still good, or wait for a pullback. The benefit there is you're buying into short-term weakness. The problem is that meaningful pullback just might not come. Wish I could tell you there's an easier way to do that, but that is the reality. That is the challenge of buying into a high momentum space. Folks, that will do it here for Friday, March 20th. Thanks so much for watching. We're excited to be back doing live streams. We will be taking next week off for the vacation, as I mentioned. Please keep your eyes peeled on our YouTube channel. We'll have some content spaced out through the week that I think you're going to enjoy. But we'll be back on Monday, March 30th, with our next live stream. In the meantime, have a joyful, restful weekend. And remember, it's always a good time to own good charts. Take care, folks.